Hey everyone, it is Evan here from the Trade Risk on Friday, January 31st, here with a weekend market recap video. We're going to cover all of the major markets, the current market environment, and finish off looking at some sector analysis. So we got lots to talk about. It's a very busy week for markets, highest volatility we've seen in some time, and some of the largest sell-offs that we've seen in several months, depending on what indice or sector of the market you're looking at. So let's jump right into it here. With our technicals dashboard, you can see Friday was a very rough session here. It was basically a 2% drop right across the board in all of the U.S. major indices. The Nasdaq fared a little bit better. Dow Jones underperforming the pack. The 5-day change, basically the same thing here. It's about 2 to 3% down for the major indices after the last week of trading. We remain below the 10-period simple moving average in all the major indices, and we're actually starting to lose some of the 50 SMAs in the Dow and the Russell 2000. If we look here at sectors, the only thing that's holding up right now in the green beautifully, but certainly not enough to do it to hold this market up by itself, is utilities. Utilities up just about 1% over the past 5 days. Everything else is in the red. Discretionary, staples, the next two down here. Discretionary mostly saved by Amazon earnings late in the week. And on the downside, you can see semiconductors off almost 7%, followed by energy and Dow transports. If we look at major markets, it's all volatility once again. 32% pop here over the past 5 days, followed by basically bonds and bonds. So long end, middle of the curve, safety all around here for fixed income is holding up in the top of the list. And then if you follow it one more, you have gold up there. On the downside, it's China, it's emerging markets, and it's oil, all underperforming here, down around 5 or 6% over the past 5 trading sessions. So with that, let's jump into the charts now. And let's take a look at what's going on here. This is our S&P 500 view. We always like to start with a weekly time frame just to get the big broad picture of what's going on here. Of course, you can see it's down a little over 2% this week. And this is the first back-to-back selling that we've seen in the market since September of last year. So we've basically had a very uninterrupted 4-month-long uptrend. After bottoming out in the first week of October, this market has been moving upward, grinding higher in this channel, and we finally have our follow-through week. So we have 2 consecutive down weeks, which is the first time it's happened. We actually broke below this trend line, first time that's happened in a while, and we're getting, just a heavy amount of volume coming in here as well when we start to look at some of the ETF components of the market. So when we look at the kind of damage here, so to speak, it is still relatively contained and relatively innocent when you look at this view, right? Because if you really appreciate the magnitude of the 30% run that we've had here over the past 4 months, we're still holding up pretty well, and we're still just starting to get off of our highs now here. So, relatively speaking, this is still fairly contained right now, but of course, this could easily get worse and this could snowball lower. So we want to protect ourselves and we want to know where we should be paying attention to. So if we go down to a daily chart of the S&P 500 and maybe we switch over to our other slightly busier view here, we have lots of horizontal levels drawn in here, which were where the market previously cared about, right? So it is now kind of selling off coming into this 3,200, call it 15 area. This is where we found some support. The market grinded sideways here right at the end of December, the end of 2019. The market started to just chop around and move sideways, and we saw buyers just kind of stepping up, supporting the market right in here around 32.15. You can see at the lows, we basically tested that on Friday. So coming in on Monday, we basically want to just gauge reaction here. We want to see how this market opens up on Monday. If if we do start with a gap lower, perhaps breaking briefly below this support, do buyers step back up here? Do we finish the day strong on Monday, or do we just cut through this and really, continue to sell off? That, of course, would be the most bearish scenario that would unfold here. We do want to see and would expect at least some hesitation, some attempt to stabilize around this general area. If not, then of course we're looking into the 3200s and sub 3200 if this sell-off continues. Now, just to give some perspective, once again, the S&P 500 is only 3.5%, give or take, off of its all-time highs. So this pullback here from, again, just historical averages of what markets tend to do in any given year is still very shallow in its pullback off of highs. And of course, we know, given the fact that this market's just gone on an even faster run to the upside, it's still well contained at this time. So, like we've mentioned in previous videos, if you sort of mentally prepare for, a potential 5% pullback, that would get you down here around 3170 or so, 3180, right around this general area here. That's a 5% pullback off of highs. If we did see, more like a 7% pullback, you're talking around 3100 in the S&P 500. And if you started to get a 10% pullback off of highs, all down around 3000. And it'd be amazing to see because, even right now, it seems like sentiment is already, fairly, crazy in terms of this pullback, thinking that this is pretty brutal as it stands. So just imagine if we did see a real kind of 7 or 10% pullback, what sentiment might look like. But those are the levels down here that you'd have to, prepare for if you were to believe that this market is going to continue and sell off. So the S&P 500, 3215 in the short term, we're basically there. Let's see how we open up next week and see how we react. And again, if it continues down from there, we can start looking into the upper 3100s and then down to around 3150. There's a bit of an air pocket below here. So if we do start losing 3200, I do think we could see a pretty quick move down into the mid 3100s in a pretty fast amount of time, just a one session, 2 session type of thing, if this sell-off really picks up steam and continues into next week. Now, if we go to, let's go to the VIX first before we jump around to anything else. Let's take a look at where VIX closed. So the VIX closed right at highs here. So kind of maximum fear into the weekend, protection into the weekend, almost a 20 here on the VIX, which is now getting to, historically, stretched, or not stretched, but historically above average levels for the VIX. Usually, once it starts getting over 20, there's got to be, persistent kind of fear or catalyst to keep it up there. The market doesn't like to kind of hold up into those high levels for too long and for no reason. You can see every time in the past year or so, every time we get up to around this 20 area, got as high as 25 or so in mid 2019, got as high as 22 here in early to mid 2019. It really kind of compresses back down and pulls back into the lower kind of 14s or so, as 15s as a general average. So right now, closing at highs here into the weekend. We'll see again how this market opens up, but right now there is protection, there is risk being priced in right here, and we'll see if that manifests itself, next week on Monday. Now, the Russell 2000, if we look at the Russell 2000 here, and we start thinking about pullbacks, the Russell 2000 now is about 6% off of its highs. So, and the highs that is made just about 2 weeks ago. So it briefly, pushed up to around this 170 level, and it kind of rejected that near-term breakout that was underway here in the beginning of or the middle of January. It quickly kind of came back down into support. It danced around at support, and then of course here on Friday, it started to really accelerate below support and start to move away from it. So the Russell 2000 is already at about a 6% pullback. So take that in context to where the S&P is about 3.5 to 4%. You got the Russell that's closer to almost double the S&P 500. So when we look here at this index, it's going to be back to, looks like a retest of this 159 to 160 area. This was the very important level that we took a long time to break out of. So the Russell 2000, I don't don't think is news to anyone else, news to anyone out there, but it's been the underperforming index for the past 12 to 18 months at this point. It finally started to break out in late 2019 above this 160 level, which had been resistance for over a year. And now you can see after, getting a little bit of a run above it, it kind of topped out here. And again, breaking down through that 164 level, that's now where, this market is sort of in the penalty box. And we talked about 164 in our last couple of videos. That was the important spot to see this market hold. It hasn't held it, and it's now below it. So we need to be cautious here in the small caps, in the Russell 2000, because of where it is, where it's broken support. It really needs to prove itself now, and this 159, 160 test, I think, is going to be an important area to pay attention to. So next week, let's watch that, but for now, I'd say uptick in volume, break of support here, kind of a nice sideways range that it broke down from. Really have to be a little more cautious here until and if we saw some type of quick reversal back over 164, which certainly it could happen, but it definitely is on the bulls to prove it at this point. If we can get back above 164, this starts looking better. Until and if it does, we got to be cautious. Last but not least is the Nasdaq 100. Nasdaq 100 here is still acting the best right now. It is very ominous here. It does not look good, but still on a relative performance basis, it's still holding up the best. So its pullback off of highs is still in the 3% range here. So really, when we look at it from where it closed today, it's actually not even 3%. It's 2.9%. So again, the pullback here very contained. If we look at the lows from just earlier in the week, it was around a 3.5% pullback on Monday's gap down. Of course, it had earnings out with like Amazon on Friday certainly helping, and just tech in general trying to hold up a little bit better in some of those mega cap names. So the Q's still best in class, but looking like this could turn into a lower high here, which could start, again, bring us down to another leg lower. You can see the very high volume, bearish engulfing bar here. So there's not much to like. It is best in class right now in terms of performance, but in the short term, this really looks fairly ominous here as this engulfs 3 days worth of action and potentially looks like a lower high that could be putting in place. So NASDAQ and breaking below this trend line, of course. So NASDAQ, we'll again see how that opens up on Monday. But again, as just a silver lining here, notice we didn't break below Monday's lows. We're holding above it right now. So there's a little bit of silver lining there for the bulls to hang their hat on. So that's it. That's the major market recap there. Volatility, pullback in the short term. Again, it's still relatively contained. So you have to know where your time frame is when you start looking at, again, a weekly chart of some of these indexes that have put in 30% rallies in 4 months or so. It's still fairly harmless and what I would consider normal in the longer term time frame. But in the short term, and depending on what sectors and stocks you're looking at, there have been pullbacks of 7, 10, and certainly for individual stocks, 15% plus off of their highs. So that's what we're working with heading into next week. Let's take a look at some of the other major markets here. TLT performing beautifully this week, 2.69% to the upside, getting a nice high volume kind of follow through week, if you will. Back above some of the prior structure here, looking like a nice kind of rounding out pattern here, and looking like it wants to come back up and retest the August highs from 2019. That's around 148 or so, a few points above where we are. I wouldn't be surprised to see it retesting that in the coming weeks. If we look at gold next, gold also acting well here. So your kind of classic safety risk off places to park cash and capital. Gold is working higher here, breaking out to new multi-year highs. Not as strong, not really, totally ripping away this week, only 1%, but still, when you look here at this weekly pattern, looks pretty nice. It's hard to not like this chart right now, especially compared to equities. So gold is working. Silver, trying to repair the early damage it saw this week. So on Tuesday, it suffered a pretty large gap down here, 3.3%. That's a big move for silver. But notice it did turn around fairly quickly. The bleeding stopped immediately, and it did try and gap up here. But notice still red on the week, and still, like we talked about on Tuesday, really want to see this back over 17.10 or so. That's going to make this more constructive, more bullish. So we'll need to see if that actually happens. But silver, not as attractive as gold, but has the potential if it can start to break out and catch up over 17. If we look at energy next, if we look at oil, USO here, third week in a row, really fourth week in a row down, third kind of heavy week of selling here out of the past four, though. It was down 5%. We're right back down to the lower end of this range that we spent most of 2019 finding support at. It was right around $10.70 or so. We're retesting that now, 4 heavy weeks down. So it is certainly stretched here in the short term to the downside, and it's coming into some support. So I wouldn't be too surprised to see some type of reaction down here. So for you short-term traders, you might have some opportunity here to catch a bounce and play some of that volatility. Again, you have to be nimble if you're going to be playing that game, so just caution advised. But 4 weeks down, fairly stretched, coming into support, wouldn't be that surprising to see some reversion. Now, natural gas, on the other hand, there's no support down here. This trend remains lower. Heavy selling continues, virtually down on all time frames. There's really not much to like about it. Again, in the short term, it did try and stabilize here. It is a very volatile commodity. So, you know, if you're really short term and you get a squeeze back above 1460, it's probably hated enough that once again you could catch a quick reversion to the upside here and catch a little bit of a bounce. But again, it just depends on how active you really are and you want to be. So that, I think, covers all of the major markets. Let's go to some of our other sectors, our sector look here, and take a look at what worked and what didn't. So again, utilities here, best performing over the past 5 days. Look at this chart here, just unescaped to the, just totally escaped to the upside here. Consecutive green days getting put in here. So this is certainly where chase for yield and safety is occurring. It's very stretched, so it is very tough to want to buy this index here. There might be some more opportunities in the underlying stocks that make up this ETF. But for now, got to appreciate the nice run, but it's really tough to chase. If we went to number 2 here, XLY, consumer discretionary, look at this candle here on Friday, and that's basically all Amazon. So Amazon reported some pretty blowout numbers, stock gapped up to, I believe, its all-time highs and held them. XLY was looking a little tough down here, but with Amazon's strength, high volume, it pushed it right back up. So, that's certainly what brought it up there at the end of the week. Third best performer this week was Staples. So Staples here, again, just from a relative perspective basis, is still just far performing better than all the other sectors out there right now. Again, it's pretty much coincides with safety as well when you think about consumer staple stocks. So it is holding up there and still looking like it has a little more actionable than perhaps utilities. On the downside, semiconductors. So semiconductors, easy come, easy go. This has been the leading group. This has really been posting the big numbers, the big gains here for the market, and it is now one of the worst performing in terms of pullback percentages off of its highs. It's almost 9% off of its highs right now, and you can see there's not a whole lot of prior support that is immediately below it. I would say down around 131 or so. That would be kind of where I would start to pay attention to it again. 130 is where I would expect potentially buyers to step back in, and you can see there's still a decent amount of distance to get to that point. So we'll need to keep an eye on this one, but I think this might have more room to go to the downside here for semis. So you got to be cautious there. XLE looks like just a horrible mess right now. It's coming back down to the 2019 lows. In fact, looks like we made new lows here, so new multi-year lows for XLE. Oil selling off, energy stocks are basically in line with them. High volume coming in, very stretched to the downside, but it's just not a place I'd really want to be unless you really looking for that volatility to be active. Last but not least is materials. So materials here, third worst performer this week. You can see again, kind of like we talked about, I believe we mentioned it in a couple of videos ago, but when this thing failed over $61, this was the real ominous sign here. So if we go to a weekly chart and it had this breakout attempt, this outside reversal week here, this was the week where we really kind of called attention to this and said, this you got to be very cautious on until and if it reclaims and breaks back above $61, because given the all the prior overhead supply here, it just makes it a very tough position to want to own. Just knowing that this has been stiff resistance and seeing that type of rejection candle there on a weekly chart, you had to be cautious, and it had an attempt here 2 weeks later to get back above it, had a very strong close, and then it swiftly gave it all back. So XLB doesn't look too attractive to me whatsoever. Still needed over $61 to get interesting in my mind. So that's it. That's the whole wrap up there. Lots covered, and there were lots going on. It was a very busy week. I think one of the busiest weeks in terms of earnings for the season. We still have more earnings, of course, next week, but got through a lot of heavy influential names this week. So hopefully you made it through the other side. Hopefully you made it through the volatility. Enjoy the weekend. Thanks so much, as always, for tuning in and watching. We'll be back on Tuesday to check in on these markets, see if we get some follow through, and just to take kind of the next steps in some of this technical analysis. So have a great weekend. We'll see you then.